we expect there to be more M&A this year. You may not see more deals being closed, but you'll see more deals being announced. Because CEOs of mining companies and boards of mining companies will feel the financing pressures. They'll be running out of cash. They'll see their cash flows are coming off because commodity prices are lower, and they're finding it quite tough to refinance or to raise new funding. So you have to look at other ways to create value and to grow your business. And the logical way to do that is through merger activity, is to undertake. It could be as simple as a joint venture where you've got two assets sitting close to each other in a gold province in West Africa, through to a full-scale public merger, because then you can realize synergies, you can share strategy, you can share growth platforms, and you can create a potentially, hopefully, compelling case to investors for why you should be merging and creating a new business. So we anticipate there'll be a pickup in activity this year, although actual deals close may still take time, because what you will have seen in the last 5 years is it's easy to announce transactions. It's quite difficult to close them for all sorts of reasons, regulatory being one, political being another. And the final point about M&A activity is that because of this financing pressure, the buyer-seller price gap, we think, will narrow for all but the best capitalized companies. If you're a very well capitalized business, you don't feel under any pressure to sell your business, fine. You don't offload your non-core assets, even if you've gone down the path of offloading your non-core assets. But having said that, we have seen nonetheless that even the majors have embarked on that process. We're in a cautious environment because of where we are with the commodity price cycle, and that's reflected in how the equity markets view the sector. Producers undertake a number of actions. You cut costs, you try and cut inflation or fat or flab out of your system wherever you can. That's the first line of attack. Second line of attack is to institute capital discipline in terms of new projects. You're much more selective, much more disciplined and harsher about those projects that you take to your internal investment committees and get approval from. Or you look to optimize those projects in terms of seeing where can we cut capex, how can we improve the returns on those projects. The third is, if you have the luxury of having too many assets on your books, how can we optimize our existing portfolio? This is more relevant to the larger businesses, the majors and the mid-tiers who have multiple assets on their books. And as I mentioned, the likes of Anglo and BHP are showing different ways, different means to try and optimize their portfolios. Fourth is, if conventional financing means are not so easily available, where can you go for capital? Is to seek innovative funding sources. And by innovative, it means non-traditional. Private capital is a mix of capital that exists outside of the public markets, and that can be either raised from sovereign wealth funds, from family offices, from private equity groups. And we've seen a lot more interest in the last 12 months from private capital in this sector, and we expect private capital to play a more meaningful role this year, including in Africa, because valuations frankly have moved in their favor and they have capital to offer which is not easily available from other sources.